What's up, traders and investors? Bennett with tradinganalysis.com. We hope you all had a fantastic holiday season. We'd like to wish you a happy new year. 2021 is upon us. The first trading day of the year, yesterday, Monday, January 4th, was a little bit rocky. We saw a move lower in the markets, and if you guys follow our work here at Trading Analysis, you'll know that we've been looking for a larger corrective pullback, and we did anticipate this corrective pullback to take place sometime in mid to late January and possibly sometime in February. And looking at price action on the session yesterday, many were expecting that to be the start of the larger corrective pullback. And the kind of the subdivision, the nature of the characteristics of the corrective pullback that we saw yesterday certainly did appear to be directional. And that could certainly be the case. We very well could be looking at the completion of this primary degree orange wave 1, and we're now gearing up for the wave 2 pullback. I actually think the market still has one final push left up to the upside left prior to that larger corrective pullback setting in. So let's take a minute, and I'm going to walk you through the S&P 500. We're then going to also take a look at the NASDAQ, and actually specifically we're going to look at the technology sector XLK sector spider ETF chart. We're also going to look at the SMH semiconductor ETF that we like to track. And I'm going to show you some of the signs that I'm going to personally be looking for to help substantiate that larger corrective pullback. And I'm going to identify the price pattern development, which leads me to believe that this market could very well see one additional high before that larger corrective pullback sets in. So looking at the S&P on the weekly time frame, we've really been in a period of correction since January of 2018. We've been in a period of expanding volatility. You have lower lows, you have higher highs, and of course the trend lines that are sourced from these price extremes continues to be respected and act as resistance. So I'm going to drop a circle here on this price action because this is what we're focusing on today. And we're going to get off the weekly chart. We're going to first drop you to the daily chart. You can see where that white circle takes you. And now we're going to go all the way down to a 1 hour time frame. And what I want to focus in on is all of the price action that's taken place since the October 30th low. I'm viewing the October 30th low as a wave 4 completion. And we're now in the final fifth wave, which will then complete a wave 1 of a higher primary wave degree. Off the daily, back down to the 1 hour, let's go ahead and zoom in on price action here. And what I want to note is the beautiful 5-wave rally that took you into the November 9th high when we had the news out of Pfizer. That was met with a corrective pullback in the S&P and an even sharper corrective pullback in tech, specifically the NASDAQ 100. From there, we count 5 waves up into December 9th. And what's really rather interesting is Wednesday, coming into the 9th and the 10th, we had a very sharp move to the downside to the tune of over 3% in the NDX, the NASDAQ 100. And at the time, many people were looking at that and suggesting perhaps that was the start of this larger move. But back then, we were able to identify the fact that we just completed a third wave into our 161.8% fib target. This was also evident in several other leading sectors and indexes, and we suggested that the corrective pullback that followed would yield a move to new highs, and here we are sitting. We've since printed the new high. From here, out of orange wave 4 or orange wave 3, we complete an ABC correction in wave 4. We then have a 5-wave rally into the January 4th opening high. And then we see a very sharp move lower yesterday. The overall corrective pullback found support at a 38.2% Fibonacci retracement of the wave 3 advance. So if you were to draw a fib retracement of this entire move from the wave 2 low into the wave 3 high, you'll notice that 38.2% is exactly where we found support. We also saw intraday tick divergence and some other market internal indicators which were suggesting that this trend would reverse and that this was just an initial directional corrective pullback prior to the final 5-wave move to complete the required subdivision to suggest that a larger wave 2 was going to take place. A bit of a note about this wave 2, it is a wave 2 positions. They can be very tricky to trade. and they can take you to a variety of retracement levels. So we have no idea how large this correction can be. Wave 2s can act in a variety of different manners depending on where and how they're taking place. So when we do see the final rollover, we'll be sure to update you and keep you posted with any targets that we have. But zooming in back to the 1 hour chart, yesterday's market low was very close to what's referred to as wave count invalidation. And in the world of Elliott, wave count invalidation essentially tells you that the interpretation that you were previously tracking, the pattern that you were tracking, is no longer valid, and it's time to look for alternates. And if that is the case, if the S&P were to fall south of 36.45.99, that's when I would get more concerned and start to look to protect longer-term holdings. If in fact that does materialize, what would simply happen is this entire fifth wave structure would then turn into a ending diagonal of the contracting variety. I'm not a huge fan of the ending diagonal count in that we don't have clear three-wave subdivisions in the fifth wave position. And given that this would be an ending diagonal in this count, the 1, 3, and 5 positions must have three-wave subdivisions, unlike a leading diagonal where 1, 3, and 5 can be 3 or 5-wave subdivisions. So back to the S&P here, I think we're either completing 4 and we're moving higher in 5, or alternatively, we do get another probe back to the low, retest support, and then turn higher. We could even break yesterday's low, but as long as we trade north of 36.45.99, I'm going to continue to operate under the assumption that we do have one additional high left in the market. Now, let's take a look at some of the charts that support this outlook. Looking at the XLK Technology Sector Spider ETF chart has a beautiful 5-wave subdivision in development within this final 5th wave move. You'll notice off the October 30th low, we're going to get off the daily, and we're going to focus in on this price action on the 1 hour chart. Again, beautiful 5-wave move into November 9th, sharp directional wave 2 corrective pullback. The wave 2 pullback in the NDX was about a 50% correction, unlike the S&P, which saw a much shallower retracement. Inside of the 3rd wave high into the end of December, you have a beautiful 5-wave subdivision. Note, December 9th, what happened? We complete the 1618. We have a directional correction. This directional correction squares up in terms of magnitude to the wave 2 of the same degree, and is supported based on the guideline of alternation. You have a directional correction here, squared up to a sideways corrective pullback here. Typically speaking, the roles here are reversed. Wave 2s are usually the kind of shakeout point. Wave 4s are typically more sideways in nature. But given the fact that they do alternate corrective patterns, this is very much so a valid interpretation. Out of wave 4, we rallied to new highs as we had forecasted, and again, 3 waves down right into the 38% retracement as we saw in the S&P. This again could also still be A, we get B, one final move lower, but as long as we trade north of 125.36 in the XLK, this final 5-wave subdivision can trade out. Once that comes to completion, I do think it's time for a corrective pullback. We have a very clear trend. We continue to see a loss in momentum, and this is certainly something that I'm going to be looking to take advantage of on the downside when it does materialize. So that's the XLK. Let's now take a look at the SMH. Semiconductors have also led this market since the March low back in last year. And again, coming out of October 30th, we complete a wave 4 correction. Wave 4 squares up to wave 2. Out of wave 4, we're going to focus in on all of the price action that's taken place since. Off the daily down to the 1 hour, there's your orange wave 4, which you can see here on the daily. Back to the 1 hour time frame, up in 1, down into 1, 2, 5-wave subdivision in blue wave 3. We then enter a sideways consolidation in the form of an Elliott wave triangle, and we're now starting to turn higher. This chart also supports one final push to the upside prior to the larger corrective pullback setting in. So tech, semiconductors, 2 leading sectors, all with the same wave count and supporting the move that I'm looking for. Apple, a very large component of the XLK. Off the daily, we're going to look at post 4th wave. In this instance, wave 4 was a triangle. And off the daily, down to the 1 hour chart, we have a 5-wave move in 1, down in 2, 5 waves up in wave 3. Wave 3 took you just shy of the 1618 target. We then have a directional wave 4 squared up to a sideways wave 2, and we're starting to turn higher. So there are 3 charts along with the S&P that do support the idea that once this market sets or at least retests the previous high, we should be looking for a larger correction. I don't think it's here just yet. I could very well be proven wrong, but that's where I stand. That's what I'm looking for in the S&P. One additional high, then I think we are going to face a larger correction. Now, last and certainly but not least, one of the market internals that we utilize to help substantiate some of these reversal points, whether they are market tops or market bottoms, is the put-call ratio. And the put-call ratio we have inverted in this instance, and we're looking at it essentially as a call-put ratio. So in purple, you have the S&P. You'll notice this looks very similar to the chart that we were just looking at. This goes back to January of 2018. This is the high back here. And here in green, we have the call-put ratio. This particular market internal is often utilized as a contrarian indicator. And allow me to illustrate this for you. Into the January high, market set a high, call buying sets a high, market consolidates briefly, call buying consolidates. The market set a new extreme, call buying sets a lower high. This is a 9-day simple moving average that we're utilizing to kind of smooth out some of the noise. And again, we have divergence set in, market correction. Notice all of the lows are supported with extremes in put buying. The December 2018 low, we establish a new extreme in put buying that exceeds that of any previous reading for the past year or plus. Market set a new low. Just as the market gets the most bearish, we see the reversal. The most recent classic sign of divergence that we have here going into the 2020 high in February, you'll notice January 17th, S&P sets a high, call buying sets a high, call buying consolidates, markets consolidate, markets hit a new high, call buying sets a lower high, divergence sets in, and we have the COVID sell-off. Here we are once again, coming out of wave 4, we were looking for the new high to not be met with a new high in call buying. So we weren't looking for confirmation there. We were looking for possibly divergence to substantiate the 5-wave completion off of the March 2020 low. The markets confirmed the move. Call buying continued, so bullish sentiment remained. Here we are once again. Are we going to push higher to the new high in the final 5-wave subdivision and get divergence on the call put ratio? That's yet to be determined. That's what I'll be looking for. If we break south of 36.45 in the S&P, that's when things, I think, could get a little bit interesting. Thanks again for tuning in. You can check us out at tradinganalysis.com and be sure to join us every Wednesday, 8:45 Eastern on Todd Gordon's YouTube channel for our TA Live Wednesday show. It's always a lot of fun. We've got the team on board. We'll take you through the markets. We spend about 45 minutes leading up to the market open. And we also often have guests on, which is certainly a lot of fun. So thanks again. Be safe. Stay healthy. Hope you're having a good new year. We'll see you on the next video update.